Hi, this is Randy with Schulenburg Realty. I'm here with
Steve Smither.
Steve Smither with Cardinal Financial. And
Yes, sir.
you probably came here today because you're going to learn a little bit about the FHA 203k program. So I brought this hammer, got to get this up here because and this tape measure thing, because I'm not really good at any of this stuff. But this is what we're going to be talking about today is renovation loans with Steve. So Steve, you've been doing renovation loans for how long?
Yeah, so I did my first one in 2008.
2008. Okay, so 2008. Wow, can I count back that long anymore?
Yeah, it's been a while.
Yeah. So when was the last kind of downturn we had in that whole real estate industry? That was right around that time, wasn't it?
Yeah, and because of that, you started to see a lot more of the 203Ks starting to happen. Yep.
Yeah, yeah. And today, and one of the reasons Steve is on here is because we have been talking about with our clients in such a competitive seller's market that we have here. It's been really hard for a lot of our clients to be able to get homes when there's 10, 15, 20 offers on a house that's just move-in ready and ready to go. And so a lot of our clients that have, our FHA clients, so they have minimum down, sometimes need the closing costs covered. They're at a disadvantage in this market. Sellers don't have to do that. So a lot of our clients now, we've been encouraging them to look at homes that are not anywhere near move-in ready and that do need some type of a renovation. So these properties are looked at more for flippers. Typically, you'd think of people that are going to buy it, fix it up, and try to sell it for a profit. Um, and they're always looking for a deal, so they're coming in a lot less, just trying to get these homes. But Steve, I'm going to bring up the flyer that you provided to us that we can also provide to anybody that is interested in this program. So Steve has a wealth of information, a lot of information he can send over to you, and we'll get you his information too, so you can reach out to him at the end. But Steve's going to do kind of a helicopter overview of the program so people understand it. So Steve, if you want to take it away, that'd be great.
Yeah, for sure. So just a little quick nugget about me. So I've been in the business since 2005. Actually, before that, I used to be a teacher, which is kind of funny to go from teaching to the mortgage world. But
A lot of education needed in this mortgage world.
especially in this program, which is the great part of this. And so I did, like I said, did my first 203k in 2008. The gentleman that actually brought me into the business, he's probably done over 500. So as a group, we've done hundreds together. We actually used to, even back in the day, go down to Hud and actually put on seminars for them on how to do the 203k. So this brings back decades ago. But
I remember that. Yeah, I remember that. And that, you have to really know what you're doing to be invited down by HUD to put on seminars like
exactly.
that.
And that's how we got the invite, because of just
Yeah.
being known for doing them and doing them off of Hud homes, even,
Right.
which I'll go into a little bit more detail later. But yeah, I've been with Cardinal now for a little over 3 years. And the great thing about Cardinal is we do these 203Ks in-house. So it is our underwriting, it's our processing, it's our money. And we keep the loans until, until all the work is completed. So it might be sold at that point, but before that, we keep the whole thing. So if there's a problem with the draw or a problem with, even parts of underwriting, all I have to do is pick up the phone, because it's all us, which is the great part about that. And Cardinal is actually a pretty big company. Most people don't know us out here in Illinois, but we actually do loans in all 50 states. I think last I heard, we're closing about 3,200 loans a month. So it's a decent sized company. We keep about 90% of our loans. So that kind of tells you a little bit about who we are. But yeah, I'd like to do like a little helicopter view first of the 203k, because I think that will give a better understanding of the process, and then questions that people might have that, and Randy, obviously, as we go, if you think of something, please interject. And because there's always extra things that, goes into the detail of it. But so
I will. And before you go on, I just want to touch, you
yes,
said
sir.
you hold on to like 90% of the loans that you write. What loans are those that you're maybe selling off the 10%?
Yeah, it really seems like the only ones that we're selling are conventional, where it's, somebody putting 5-10% down, buying a home, where they've got good credit, good income, all those kind of things. We do seem to sell right about 1 out of 10. I think
Yeah.
in the last 2 years, I think I've only had 5 people get sold. in the last 2
Okay.
years.
So I
So,
just
which is
have,
great.
yeah, I have a client I'm working with right now. We just looked at a property a couple of days ago. Unfortunately, went under contract. Wasn't able to move as quickly on it as she had hoped. But she was looking at using a credit union because it doesn't sell the loans, but she'd like some alternatives. So I'm going to get you her information after the call so you can reach out to her, because she would prefer to have a company that doesn't sell their loans. So that's why I was asking about that. But yeah, go ahead,
No, for
Steve.
sure. And nobody can guarantee them, like even the bigger banks or whatever. But the great news is, it's if they have an issue with something, they can call me as opposed to calling the 800 number, and I can give them direction, which is, I think, one of the best parts about it, is being able to still help people even after they buy or refinance, which is
I
kind of
always
cool.
say it's yeah, they write mortgages under guidelines so they can be packaged and sold
Correct.
if it makes sense for a company to do that, right? So
Yes, sir.
yeah, so
Sure.
that's just the nature of the market. So it's unusual to have a company that would just hold it forever. So you
Yeah.
always kind of
Very
reserve the
true.
right to sell if it makes sense.
Yes, sir. No, for sure. So yeah, so the great thing about the 203k is, basically, I always say, it basically takes a house and makes it into a home.
Mhm.
And you have the ability to kind of look at it from, it's the right house, the right location, but it's missing blank, or it needs updating, or whatever the case is. It's in the right school district, it's in the right, we're this close to the church, close to the school, but we've only got 2 bedrooms. How do we fix it so that we've got 4 bedrooms? And so the 203k not only gives you the ability to fix up the house, you can even add on to it. And so the stages, basically, I always say, the first thing is, like any loan, it's always the pre-approval. You come to me, you send me your documents. We'd go into more detail once somebody's coming to me, but it's the basic financials, the W-2s, the pay stubs, the bank statements. We take a look at credit. We take a look at, the income. The great news about the 203k is we can actually go down all the way to a 620 credit score, which is pretty
Great.
amazing. So you don't have to have perfect credit to be able to do this loan. The other thing is, we're only looking for 3.5% for the down payment. So the 3.5% is going to be the total project. So let's say somebody, usually the 203 comes up when somebody's already got a house in mind before they come to me a lot of times. And they go, you know what, we've got this house, it's $200,000, but we need about $200,000 to rehab it. What do I need to do? How does it work? And so after we get you pre-approved, so then what we're going to do is, we're pre-approving for 400,000. So it's the 200 for the purchase and the 200 for the work that's done. We call it the need. And so we need 400,000 to be able to get that property and to be able to fix it as needed. So that's what I'm going to be looking at when I do the pre-approval. Once I get that pre-approval done, and we can figure out if we need to deal with seller concessions to be able to make sure we have enough money, or so if it's tight, well, we've got options to be able to figure out how to do it. But obviously, the first thing would be to go find that house if you don't have one. If you do, once you find that house, then the next step really is to find a contractor. The contractor is going to be a big part of this, because yes, you think it's 200 to buy it and 200 to fix it up, but what if the contractor can do it, let's say, for 170? Now that kind of changes some of our numbers. So that's going to come a lot under figuring out what we're going to do. If it comes that, okay, we've got that, that 400 number, and we're good, it's, it fits the numbers, then we're going to give it back to you so you can go get that contract for the client. Do they need the credit, seller credit, all those kind of things? Typically, we're going to be able to close. We always tell people 60 days. That's the number that's always smart, because you just never know. There could be some issues with, let's say, the appraisal, or maybe the contractor takes a little bit longer to get us some documents, because we do get some things from them. So 60 days is a good amount of time to think for closing. So once it's under contract, we tell people the best thing you can do is do what's called the summit meeting, or what we call the summit meeting. And so basically, everybody shows up at the property. So you got your agent, Randy. You've got somebody that's called the plan reviewer, or FHA consultant. When the work that's being done is over 35,000, or it's structural, this FHA consultant basically is kind of like the checks and balances for the procedure. So he's going to make sure that the work is done properly. He's going to make sure that there's enough money for the project. He's going to go through it every time that the contractor needs to get paid with a draw. He's going to go out there and make sure that they do the work right. And so if they don't do the work right, they don't get paid. So it's a lot of checks and balances, and he's a big part of that. And then also the contractor. And I could be there too. A lot of times I am, sometimes I am, sometimes I'm not. And so that way the contractor and the plan reviewer can go through the numbers together, because most of these plan reviewers, especially the one we use, they've been in the business of they've either had their own contractor job, or they also had their own construction company, so they know what the prices are. And especially these days with the wood prices going up and all these, I mean, it's hard to keep up even what these costs are. So that's where it's important to have the contractor and the plan reviewer there at the same time, because then they can kind of talk it out together. At the end of the day, we're going to use the numbers from the consultant. So if the contractor says I can do this for 170, but the FHA consultant says it's going to cost 200, we're going to use the 200 number. The good news is at the end, if there's money left over, you have a couple options. You can either do more work with what's left, or that just pays down the mortgage. And so let's say you, instead of owing that 400 and it's 30,000 left, now the loan amount is 370. So you don't lose the money, but it just depends on where you want to put it.
That's good. So I got a couple questions that came up as you're speaking. Is this, I closed on a home January 3rd. So my first closing this year, and that was $80,000. The house needed a complete gut job and rehab.
Sure.
And it'll be coming back on the market later this spring. I'll be putting that on the market as a rehab. Now that was an investor. So to be clear, this product is not for investors, right?
Correct. So actually, it's kind of funny. FHA, back when they first started the project, they actually allowed investors. But they only allowed it for, I want to say, like 2 or 3 years, and then they got rid of it and then made it just owner occupied. And the problem was, back then they did it because there was such a surplus of houses that needed rehabbing. They didn't care where it came from. Let's just update, these homes. But it is owner occupied only. So they do have to plan to live there. It doesn't mean that they can't have another house that they're selling, or, that what you also see sometimes is people moving from, let's say, a condo, and now they're moving into their, the single family. If it makes sense, they're still allowed to do that. And it also doesn't have to be a single family home. It actually could be anywhere from a 1 unit, 2 unit, 3 unit, and 4 unit. Which is actually pretty wild. Matter of fact, even the loan limits, because of that, are significantly higher. Actually, a 4 unit, you can do a 4 unit in the city for $809,000. That's the max loan amount. So you can there's a lot more options now with that.
And I think that's a really great part, because a lot of my clients that I'm showing, they're first time buyers and they're looking for property. They're getting squeezed out of that single family home that they're looking at for around the $200,000 plus or minus range.
Sure.
But there's a 2 flat, a 3 flat, and in some cases a 4 flat, anywhere from like 250, 354, but it needs some work.
Right.
Those are good candidates, right? Can you use the income, just on a side note, from
so that's the great part, is you can actually use the rental income to qualify for the property. So on 1 and 2 units, on 3 and 4 units, there's self-sustaining is another part of that, where the rental, which they consider even the unit you live in, if you counted what the expected rent would be for all 4 or 3, that has to be able to match the amount of the mortgage payment. So that's the only caveat on 3 and 4 units.
And when you say mortgage payment, principal, interest, taxes, insurance, the whole
insurance
nine
and
yards.
taxes.
Yeah, and that's very doable in our area.
Yes, sir.
So we're in the northwest suburbs of Chicago, if you don't know, and you're watching this right now. So any properties there, we can help you with, and Steve can help finance for you on this program. But that's definitely a key for these buyers who are being squeezed out of the seller's market, to be able to look alternatively at a 2, 3, or 4 unit in that example. And because a lot of these that I look at, I'm going to take DeKalb, for instance, near Northern Illinois University. There's a lot of 2, 3, 4 units in that area, but a lot of them are run down. The landlords have not taken care of the property. You can come in and pick up a property there around 125 to 150,000 in this seller's market, and probably go in and do a nice renovation of that. and make your owner's unit extremely nice, and then have the ability to generate some revenue on the other unit that you're not going to occupy. So it's a real viable solution, and that is, I think, not looked at a lot right now by buyers that are out there.
And for sure. Yeah, it's a great way, especially in the beginning, because actually another thing that's actually kind of cool about the 203k is while the work is being completed, as long as there's value, we can actually escrow up to 6 mortgage payments while the work is being completed, so they don't have to make a mortgage payment.
So wait, you're telling me somebody can go on a property like that, use this program. Let's say they're renting somewhere and they have 6 months left on their lease. That work can be done, and that mortgage's payments being paid, so they're not double paying a rent and mortgage payment at the same time.
Yes, sir. Yeah,
That's
amazing.
so that's really good news. Yeah, thanks for sharing that.
And there's actually even another little caveat to that. So I was talking about how HUD homes are a little different. There's also a HUD $100 down program that can be done with the 203k.
So
you can literally
for those listening, for those listening, what is a HUD home? What does HUD stand for?
Basically, it's a home that's been repossessed by HUD, an FHA deal that fell through, and HUD had to foreclose.
Okay, so somebody had an FHA mortgage on a property, they couldn't make the payments, ran into some tough times, and then they were foreclosed on. HUD Housing and Urban Development took back that property, and now it's being made available to the public again. So that's a HUD home. And so what can they do on a HUD home?
Yeah, so either a 203k or a regular FHA loan, they could buy it with $100 down for the down payment. So instead of the 3.5%, they only need 100, which is
it's huge. And a lot of those too, just for those that don't know, if you're looking at a HUD home, when they put those homes on the market, they don't open them up to investors to be able to purchase those until it's been on the market for a certain period of time. So that time is usually 21 days or longer before they open it up to investors. They'll look at it if it didn't sell to an owner occupant. So they do give preference, even in the seller's market, they give preference to those that want to occupy the property as their primary residence.
Yep. Yeah, which is great.
Yeah.
So so going back to once we get that contract, we got the FHA consultant's going to do something called a plan review, and also what's called specification of repairs. And then we're going to have the bid from the contractor. The contractor is going to start working on getting us information because we're going to have to approve him. So, or them rather, the company. They're able to sub out to anybody, but they have to be the general contractor and they have to be over the project. So let's say they do everything, but they don't do electrical, but we're, adding some outlets or something. They could always hire somebody as a subcontractor to do that for them, but they're still ultimately over the project. So we get like resumes from them, a couple of, people that have, worked with them in the past that had no problems. We do check to make sure that they don't owe anybody they shouldn't, that kind of thing. And that all goes along while we're doing the regular approval process as well. So we're going to order the appraisal. The appraisal is done basically 2 in 1. So it's an as is and an after improved value as well. So what they do is they take that plan review, or the appraiser takes that plan review and gives that value of what the house is going to be worth after all that work is completed. And so to kind of go into that, we can actually lend up to 110% of the after improved value. So on that case that I was talking about, we have 200 purchase, 200 to do the work. But let's say the appraisal comes in at 390. Guess what? We're still good. So even though you don't necessarily would want to do something maybe like that, but if it's the right place, especially in this market, it's okay. So we're able to go 10% above whatever the appraised value is. That's what the max is, what we can work with. So that's amazing.
I'll give you an example. In this market, I showed a house last night in Crystal Lake, Illinois, to a client. We sold their home in Marengo, and they're looking for a house. The owners were home showing the house. It had just been on the market a day. There were 5 groups of us inside the home at the same time. So a realtor like myself with my clients, 5 groups of us at the same time in this home, which it's about 2,600 square foot home.
Okay.
Looking at it at the same time. And this is a house that needs a little bit of work too. It wasn't a perfect home. And it's listed around 289. It's going to go for probably 320, 330. is my estimate by the time it's done. They've already called for highest and best offers. And so in this case, you can have a house, you have 390 or appraisals for 390, you have 400 into it. It's only $10,000 difference, but it is the way that our clients wanted the home. They told the contractor, we want granite counters, we want new cabinets, we want new flooring, can they rearrange how the house looks inside? There was 4 bedrooms, we want 3 because we want a larger master bedroom with a nice master bath. These are all things they can do on that program.
Yes, sir. Yeah, and if it's minimal enough, if it's below 35,000, and it's not structural, we can actually even do it without the plan reviewer, and it is able to close a little bit quicker because there's no plan reviewer involved. So, matter of fact, we even give the contractor money up front to be able to get started right away on the project because it's smaller, whether it's just paint, carpet, maybe appliances, which is a thing a lot of people don't even realize. They can actually even get new appliances as part of the 203k as well. Matter of fact, a lot of times I actually had one in Elgin that's kind of like my perfect example of this. A client was going out there, he was just going to do a regular FHA, and he got to this property and it didn't have a refrigerator and oven. And he's like, I really love this place, but I don't have the extra money for the refrigerator and oven. And so what they did is they wound up doing a streamlined 203k or the mini K or whatever they want to call it. And basically they wound up doing the oven, the refrigerator. And then what they also wound up doing is they wound up doing carpet and paint, and they wound up doing a small repair on the roof as well, because they're like, if they're going to do it, they might as well do whatever needs to be done on the property. Actually, I almost forgot, they also added a water heater as well, because they knew that was going to go at some point. Wow. And so being able to do that, and it didn't take much more. I think it only took like probably about a week longer than they expected to close. And
Boy,
so now all of a sudden they got these new appliances and they didn't have to put it out of pocket.
And so Steve, they probably were talking to you about their financing, and they had a conversation like this, and you brought that up as a possibility and how they could make this work.
Yes, sir.
So, and for those listening, watching, this is why I think it's so important. You know, I'm a realtor. I do not do mortgages. I used to. Steve and I used to do mortgages, not together, but we were competitors. And Steve did a great job. We did a great job. But I just focus on real estate. Steve doesn't do real estate. He just focuses on mortgages. And it's really important that you connect with a loan officer like Steve that really knows his business and can give you solutions like this when a snag comes up, or when you're looking at how can I make this work. So one of our first things we encourage you to do before you start looking at houses is to get in touch with Steve and have a conversation with him about what's the best way to move forward. Get everything, get yourself mortgage ready. I mean, you want to be ready to pounce on that property and get the best deal when you can, and know what all your options are. So Steve, I brought up the flyer. I'm sharing the screen here on, I think, what you just alluded to. Was that one of these programs?
Yeah, so they call it the limited. We used to call it the streamline. They actually even also used to call it the mini K. It was the one that's 35,000 or less. And then again, there's no minimum because it's meant to be a smaller loan. So it could be as simple as. So one of the other things with FHA that you deal with is FHA has a standard of livability. That's what they're looking for. They're looking for livability. And so some of the times whenever somebody goes to buy a house, if there's some peeling paint or maybe some broken windows, those are things that have to be fixed when you're doing an FHA loan. One of the ways that to get, I guess we'll say, get around that or circumvent it is for us to do a 203k where we can fix those things so it's not an issue. And matter of fact, when the plan reviewer goes through the house on the full 203k, he's actually going to make note of things that have to be fixed, that will go into that list. So you may not even, the client may even go through the house and not even notice that. This is the one I always remember. I did a deal down in Lincoln, Illinois, and the garage out back had peeling paint, and they didn't even think anything about it. It was like it's a garage, nobody thinks about it. But unfortunately, FHA required it to be to be fixed. And so I always laughed that my client actually had somebody kind of go out there and fix it, and they actually painted it pink
Oh,
because it
really?
didn't matter. The color doesn't matter to us.
Yeah.
All that matters is it's structurally sound, and in this case, livable is what FHA calls it. So
And it's
some of
funny
those things will need to be
yes.
fixed, but that's something that will be figured out through the plan review.
I think it's funny you bring up that example because I just showed a house in Marengo the other day to a client, and the realtor specifically put in the listing, no FHA, there's peeling paint on the garage. And, in a seller's market, it's okay. I mean, the house actually is under contract now, but in a buyer's market, someday we will switch again. The markets will change. You want, as a realtor, to have the best opportunities for people to buy, whether it's FHA, conventional, VA. So to limit that in the description and just say no FHA because of peeling paint on the garage, which is a simple solution, simple fix, is a mistake. So so it's great that can be utilized for that, or just go out and get permission to scrape it and paint it and take care of it if the seller doesn't want to do it.
Yeah, and again, like a lot of things, it's just information. I mean, a lot of agents don't know about the 203k. And so because of that, they don't realize that there's another option.
They will now because they'll be watching this video.
Exactly.
Exactly. So this is informative to anybody that wants to take the time to listen. Is there anything else about the 203k loan specifically you want to talk about, Steve?
Well, and I just wanted to also just to talk about the ending of it real quick. So once we get our clear to close and the closing scheduled, if it's a streamlined 203k, literally the contractor is going to get money from day one. And so they're going to get money to be able to go buy, the vinyl flooring or the paint or whatever the case is that they're going to be doing. Yeah. On a full 203k, the contractor is going to basically front some of the work. Okay. So you're going to want to find a contractor that's not just a guy, starting out, somebody that it's going to be a company that's got some stability, which is a great thing in general, because they're going to have to front a little bit of the work. So maybe they have to go front, let's say they have to front the vinyl. So they got to go spend $1,000 on the vinyl so they can put it down. Right. And then whenever it's completed, we can do what's called a draw, which means whatever has been fixed, we can give money that's been allotted for whatever has been fixed. Same thing with appliances or whatever. And they're allowed up to 5 draws during the process. So they're able to keep getting money. And the reason why a lot of contractors like this is because at the end of the day, they know they're going to get paid. And so they're not relying on a client to come out of pocket with something. They know the bank's going to give them the money as long as they do their work properly.
Okay.
So to go along with that, so we go back to my scenario where it was 200 to buy, 200 for the work. We're also going to do something called a contingency reserve. Okay. The contingency reserve is anywhere between 10 to 20%. And that contingency reserve is number one goal is to make sure that if, let's say somebody's knocking down a wall, what if we find mold? Or what if we find some support that needs to be redone? Where's the money going to come from? Well, we have the money set aside because of a contingency reserve to be able to fix the problem. The example I always give is I had a client who did one in Elgin. That's where I do quite a few of them. And there was an issue with the flashing on they redid the roof, but when they did, they found out there was an issue with the flashing on the chimney. And so because we had the money set aside, they were able to fix the chimney for, it was like another $6,000 that they didn't expect, but we had the money sitting there and they were able to fix it. And then the project didn't stop because of lack of funds. And so it's another thing, that checks and balances to protect. And again, if there's money left over at the end of the project, you could maybe upgrade something if you want, or it could just pay down the loan like we discussed earlier. So that's kind
Steve,
of
I've heard of I have one person I know whose father-in-law inherited a house. The guy he inherited it from was single, never had any kids, anything, and he basically inherited the house, through the will, and it needed a renovation. So they did what you're talking about, where they just tore down all the walls and started to renovate it. But they didn't need that program after all, because when they took down those walls. Guess what they found behind the walls?
No idea.
$1 million cash.
Oh,
How would you like that to have happen to one of your renovations?
yeah,
You have
that'll
any
work.
stories like that where they've torn down the walls and all of a sudden
I
there's,
mean, you hear about it, but wow, that's
I
amazing.
could not believe it. That's a true story. $1 million cash behind the walls. So you never know what you'll find when you tear down walls in a
Apparently
renovation.
not.
So yeah, so you may or may not need Steve.
Yeah. Too funny.
So
That'll
Steve,
take care of the contingency reserve.
there you go. That'll take care of the contingency. You can pay off the mortgage quickly. But so Steve, if somebody found a house and it just needed to be torn down, they can't tear down a house and use this program, right?
Yeah, so that's a great question. So actually, the 203k allows for, as long as we have a foundation, everything else can be redone. So
Okay.
we have to use the original foundation. And again, it could be upgraded or whatever needs to be fixed, but
Yeah.
literally everything else can be done. The problem that you sometimes run into in those kind of scenarios, though, is the value, being able to get enough of the appraised value to be able to cover knocking down basically the building and being able to build back up. So a lot of times you'll see where maybe they'll knock down like part of the house because it's just, you know, the wood is just gone or whatever, and then they'll keep, like, you know, let's say half of the building and then rebuild and maybe even add additions and whatnot by doing that, and then they'll get the, you know, the blueprints made by an architect to be able to do that. That is, we do see that for sure, especially in the city where some of these houses are from the 1800s. Parts of the houses are they just need to be redone. And but
Yeah.
again, if somebody, and again, like the city, that's what you get a lot. You get a lot of people where they'll go in and they'll redo 1 or 2 rooms because that's what needed to be done at the time. And then over time, those are still good, but now the other ones, they need to be done. So you see a lot of that for sure.
Now, do you have a list of contractors over the years you developed? I mean, a lot of our clients, you know, looking for homes, but they wouldn't know who to call. They might hit Angie's List or things like that. Do you
Sure.
provide any resources for
So
people that are looking? to do that?
I always laugh that
Yeah.
every contractor is a contractor waiting to be fired. So it's part of the nature of the business. Sometimes they have a hard time being able to finish projects and whatever, and that's why the checks and balances in this program are great when you're dealing with a contractor. But because of that, a lot of times we don't normally refer, because we always want to make sure that our clients have the option to be able to find who they trust and believe in and that kind of thing. And if something does come up, it's not a big deal for us to be able to move on and go, okay, we're going to have to find a new contractor. And that happens. And it's not a big deal because,
Yeah.
again, they're not getting paid on work that they don't do. So it's not like if you lose a contractor, that's going to be an issue. But it does come up definitely for sure. And our plan reviewer, he, as a network of people that do the 203Ks as well. And so a lot of times he'll refer somebody. And again, for certain projects, I do as well. But overall, it's one of those things. It's just, on general, I try not to do that if I can help it, because again, at the end of the day, you know, you're going to feel more comfortable with somebody different than I will. And so to just be a blanket here, use this person, it may not be a good fit. And so we want to make sure that the fit is right for the client. And so we try to stay out of that, and then make sure that to vet them to make sure that they are qualified and that they can do the project.
Okay, so do you suggest they go somewhere specific like Angie's List? I mean, if they don't know anybody, they just ask around.
Yeah, I mean, I always say the first person I would ask if I was doing it myself would be the plan reviewer.
Okay.
Because at the end of the day, their job is to help make sure that that is done properly. Just because
All right.
he's going to see it, he's going to know who does 203Ks in the area. And so he's probably going to have, especially if you trust, you know, if there's a good bond there where you were like, oh, I like this guy. I think whoever he tells me, this is probably going to, and a lot of times he'll give 2 or 3 of them where you can talk to them and see if it's a fit as well. That's probably where I would go, just because, again, they're in the business.
Okay.
You know, just like I would go to you because I need to know about real estate. I would want to go to a plan reviewer because he's the one that knows these contractors. So that's kind of, you know, my thought process.
Okay. And again, for those watching this, if you're looking in the northwest suburbs of Chicago, we do have contacts, so we can connect you with some contractors and different tradespeople that can help you. Again, I am not one of those. This is not me. So
Me neither.
yeah, and my wife can attest to that, unfortunately. So Steve, thank you. Is there anything else you want to share before I'm just going to ask you just to give maybe a 1-minute summary of the procedure and the process from once I have a client that's maybe interested in this program, what's the process, just in a 1
Yeah, I
minute
mean, the
summary.
biggest thing is, reaching out to me so we can get, the paperwork to make sure that the person's qualified. That's the big
Okay.
one. And again, I always tell people this isn't the program for everybody. It's the program for the right people.
Yeah.
And if you're looking to, get some instant equity, that's a possibility of why to do this. Making that house a home, and you don't have the money to be able to do it. Those are the main reasons to do it. If you found a property but it's one of 20 and you're like, let's do the one that needs work, the 203k, it's going to take time. Again, contractors
Right.
sometimes can take months to be able to finish the project, so you got to be patient, you got to be a part of the process. So it's not for everybody, but it is an amazing program that gets you into a house for a minimal amount of money down. And again, many times people are able to do these rehabs. A lot of times we're even able to refinance them after the fact and do a conventional loan, and they already have equity to get rid of PMI just because they did the work. It's amazing sometimes the values that come back. Sometimes I had one, literally they bought something, it was like 350 out the door, the price was around 350. When it was all done, the appraisal came in over 500,000. It was nuts.
Wow.
And they made one payment and it came in over 500. I mean, it
Wow.
was amazing. So there's definitely reasons to do it for sure.
Yeah, great. Well, thank you, Steve. And we have up on the screen, if you need to reach Steve, is that the best number to reach you at, Steve?
Yes, sir. That's my cell. So you can get me anytime, 9 to 9 daily.
Okay, so 847-942-5151. If you need to reach me, my number's up there, 224-805-2616. This is going to conclude the portion of the FHA 203k renovation loan overview. If you want to stay on a little bit, I'm just going to have Steve share a little bit more too about what he does, because this is not the only thing that he does. So Steve, you also have options for this program. So can you explain a little bit about what this one is? This is the IDA access.
The IDA, yes, sir. So IDA, Illinois Housing Development Authority, they've actually got a program that basically gives money to be able to use for down payment to be able to purchase a home.
Okay.
There's some restrictions on it as far as what's able to be done. There's actually a few different programs, anywhere from being forgiven all the way to being paid back right away. But it really is for people that, maybe just they can't seem to figure out a way to be able to save that down payment. And so they've got a few $1,000s in the bank, but they just don't have enough to be able to get the down payment. These are the options to be able to get in the door without having to, figure out another way to be able to get the down payment.
Okay.
Most of them, you have to live there 10 years to be able to have it repaid. For like the repaid one, you got to live there 10 years for that to be forgiven. But the great news is, let's say you only live there 5 years, they forgive half of it. So it's prorated, which is
okay.
Great.
That's really good. And
Yes,
then we have one more flyer here, and that's on the Fannie Mae Home Ready program. And it's just another overview.
Yeah, so we've got the Home Ready and the Home One, which was Freddie's version, and actually we even have our own version, which is kind of cool. So they're basically for people that make a little less money than the area. So it's considered like lower income. So we're able to give them better deals where they only have to put 3% down, or even 5% down, where the PMI could be better, the rate's not as bad, that kind of thing.
That's
and
excellent.
then we actually have something also that we actually just Cardinal's actually one of the first. There was 3 lenders that were doing this. We were one of the first ones working with Freddie, doing something called Borrower Smart, and we're actually able, if they qualify, they can do I guess we'll call it the education on buying a home, and they can get up to $1,500 as a credit at closing for the purchase, which is pretty amazing.
That is amazing. Well, so I brought this up just to let you know, Steve, we don't ever want to pigeonhole a lender, especially as good as Steve is, into just one specific product, but he is the expert he and his team with the FHA 203k renovation loans in our Chicagoland area. So we're very privileged and honored to have Steve join us today. But again, Steve can do anything. So any conventional loan product, FHA, VA, reach out to Steve. He's a great lender. More than that, he's a great guy, great family man, just a overall good character. Not a character, but a good character.
Well, maybe that's true.
Yeah. So we like to highlight really good people and good loan officers. So give Steve a call if you need anything. And again, Steve, how can they reach you?
Yeah, you can reach me on my cell phone at 847-942-5151, or you can even go to my website. That's actually just my name. So www.stevesmither.com.
Fantastic. So Steve, thank you. I'm going to stop the recording. And for those, again, that had a chance to see this, hopefully it's educational. And if you have questions, reach out to Steve or myself, and I'll certainly get you in touch with Steve.